What does it mean? If inflation is slowing, what does that mean for public equities?
Yeah, so I mean, let's think about what we've had in terms of data. I mean, we obviously had U.S. and CPI and Canadian CPI come out recently, and it's showing a slowing trend, and we're getting a cooling of inflation, and
it's still increasing, but it's at a slower rate.
That's right,
yeah.
And we're getting to a point where it's becoming a little bit more palatable. And so, as you think about what that means for the short-term interest rates and decisions by the Fed and the Bank of Canada, it's given them enough evidence to say, okay, maybe we'll stay on hold for now and see how the data comes in. And then, as that translates to the equity markets, I would just say they're following the bond market. They're following yields. And, it becomes really tricky and can be quite volatile because you're getting days when yields are moving around 10, 20 basis points. And you're getting 50 basis point moves in a month. And what that means for equity investors or any investor in risk assets is that the risk-free rate that you're using is the 10-year Treasury yield. When that's moving around so much, it gets really, really difficult to get comfort that this is the fair value for any individual stock or the market. So I would expect volatility to remain.
Yeah. Is there anything we just talked about the fall fiscal update from a personal finance standpoint, taxes, and I'm not going to ask you about that. But did you hear anything from a deficit standpoint that makes you kind of pay a little more close attention?
Yeah, so we were actually quite pleased. We thought it was a fairly responsible update, and we didn't hear anything that scared us. And I think going in, there was some skepticism that we may hear about some bigger initiatives. And so I would just say it was disciplined. There was a narrow focus to the initiatives that they're bringing forward, and so nothing came out that really scared us.
Good. I know we're going to talk a bit about earnings and some of the themes that you've been hearing in terms of what's been coming out of companies. And this term I've not heard, but the challenge I know for the central bank has been a stronger labor market, and the fact that they keep doing what they're doing and then they're not seeing unemployment numbers move up a little bit.
Right.
And you talk about labor hoarding.
Right. Yeah. So labor hoarding is a thing. It became a thing after COVID. And so what you had was a whole bunch of companies that let go of employees when they saw demand fall off a cliff.
Yeah.
And they tried to hire them back. And it was really painful and a difficult experience.
And expensive, I would imagine.
And expensive. Yeah. And what it has led to is a theory that there are some companies out there that are a little bit less sensitive to incremental changes in demand in terms of cutting costs.
Yeah.
And could that be a factor? You throw on top of that some of the new onshoring trends that are taking place, and we're building manufacturing facilities, and on top of that, some of the demographic trends that are taking place. There's an argument out there, we can agree or disagree, it's probably a debate for another show, that there's maybe a structural supply-demand imbalance in terms of labor in the market. We can debate that on another show, but for now, what that means is, are companies currently trying to see how demand comes down?
They're trying to smooth it out themselves,
that's right? And not making that kind of rash decision saying, okay, I see demand starting to fall down, I'm going to cut. No, they're waiting around and they're seeing. And that causes some difficulty for the central banks who are just trying to say, no, we need to get inflation down. Wage inflation has to come down. And it's probably not moving as quickly as they'd like to see.
That's interesting. What else are you hearing from companies in terms of just the trends, I would say, in earnings?
Yeah, so, earnings season Q3 wrapped up. It's always a good season. Companies always, guide low and then beat. So you had 80% of companies beat on earnings. You had, I think, 60% of companies beat on revenues. And, at a high level, earnings grew year over year for the first time in several quarters, so that's a positive. When you take out the Magnificent Seven, earnings were actually down 4%. So they were up 4% with Magnificent Seven, down 4% without. Revenue didn't grow as quickly, but it was still up. And when you think about some of the trends we're hearing, I'd point to the consumer and how different cohorts are doing as a trend that came out quite clearly to us. I would say we heard from several management teams that the lower income cohort is weakening, and they've drained down their excess savings, and they're starting to see decisions which are slowing consumption trends across a whole bunch of different sectors. So we heard it from Walmart, we heard Home Depot come out, and they said, look, purchases of over $1,000 are down 6% year over year.
Yeah.
So some difficulty in terms of low-end consumer. Other than that, some of the guidance came in a little bit weaker. So trends for Q4 and for next year, estimates are starting to trend down a little bit.
What about sectors? And when you come out, like I know you've got, we can talk about industrials and real estate and technology, but industrials, you're thinking things are looking okay.
Yeah, so industrials is a really great sector for us because it's such a diverse group of businesses. And you have a whole bunch of different end markets. And, I'll go back to the onshoring, nearshoring, friendshoring, whatever you want to call it. There is activity that's taking place. And every time a new chip plant gets built in Arizona or a new air conditioning plant to supply the chip plant with air conditioners gets built.
But it's all happening here.
It happens here. And so these industrial companies end up finding new verticals to sell their goods into. And it does present probably an opportunity that isn't just a 1 year kind of time frame.
Yeah. Real estate?
Real estate, there's pockets that concern us, and we would be avoiding certain areas of kind of the retail mall space.
Yeah, you see all the distribution centers going up and all the malls not doing so well.
That's right. That's right. We would probably be avoiding some office exposure outside of the main cohort. You've got main cohort office doing great. Outside, maybe avoid some of that. And then you mentioned technology. Look, I mean, I think technology is a theme that has excited everybody this year, and there's still pockets that are very exciting. And when you think about the exposures to AI, and not just the chips, but the productivity tools and companies that are presenting new opportunities for companies to protect margins, and the data infrastructure software companies, lots and lots and lots of good things happening there.
What do you think about, my last question, forget about a minute, but the soap opera that is OpenAI and Sam Altman? Because I think, I kind of like, they fired him, they brought him back, now the board's fired, now he's back, and I'm just like, okay, so.
Yeah, so it's.
But beyond the entertainment value, is there something interesting there?
So it's great entertainment. I would say there's one big conclusion that is really positive from my standpoint, which is the future of AI is in a much better spot today than it was a week ago. And when you think about the development of you've got this nascent technology, which has been kind of initiated by companies like OpenAI and others. And with any company like that, it's a very young company, and it doesn't have a corporate governance structure that is super robust. And then they start dealing with Microsoft, which is a much larger company who's trying to move and commercialize AI. And so you get some friction. And so what's happened in the last week, I think, is really positive because you've essentially compressed the time frame, which could have been about a year, 2 years, 3 years for OpenAI to mature from a governance standpoint. And it happened in a week. They've got Larry Summers now leading the board. We've got Sam Altman back in leading the organization. And so I'm extremely excited. And I think that the future of AI today is probably in better hands than it was a week ago.